morning, everyone, and welcome to our webinar on Pillar 2. We'll make a start. My name is Darren Yeo. I'm a SW partner and a corporate and international tax director at SW Australia. So firstly, we acknowledge the traditional custodians of the land and their connection to the land, sea, and the community. We also pay our respect to their elders, past, present, and emerging. So for today, for the best viewing experience, feel free to go on full screen mode. There should be a button on the right hand side of your screen. Now, if you have any questions, feel free to use the Q&A button, and I'll address those questions at the end of the session, or my Pillar 2 team members, Anthony and Kate, might respond to some of those questions. But there'll be plenty of time at the end for questions. So we'll make a start. So this morning, we'll look at the purpose of Pillar 2. When does the new measures start? Who does it apply to? Then we'll ask a question, what will be the obligations of groups headquartered in Australia? And on the flip side, we'll ask, how about subsidiaries of foreign headquartered group? Do they have obligations in Australia? If you do need to perform Pillar 2 calculations, we'll go through the steps to perform those calculations. We'll go through some very simple calculations to give you an idea as to how it all works. And we'll talk about its impact for tax effect accounting in the near term. Now, I note that today's sessions will not go into the detailed calculations in relation to what we call globe income, and I'll explain what that is, and adjusted covered taxes and effective tax rates. We'll go through the detailed calculations in future workshops we intend to hold. So in those sessions, my Pillar team members will go through the detailed calculations, and we plan to hold those workshops once the legislation is released by the government. So firstly, what is the purpose of Pillar 2? So the purpose of Pillar 2 is to stop countries racing to the bottom in terms of the corporate tax rate. What the rule seeks to do is to set a minimum effective tax rate of 15% in each and every country or jurisdiction in which your group operates. So you know the key term there is that you need to have a minimum 15% tax rate, effective tax rate in each and every jurisdiction, and this is not a global effective tax rate. Australia will be adopting Pillar 2. What about the status in relation to other countries? Firstly, I highlight that the US has implemented similar rules. So the rules using their acronym is called the GILTI rules, so G-I-L-T-I, GILTI rules. And the reason why I mention this is that if you are US headquartered or have US operations, you will need to account for the differences between the two rules. In relation to other countries, and shoot me an email if you want to know the status in relation to your head office jurisdiction. Countries like Japan and South Korea have enacted the law. New Zealand is ahead of us. New Zealand and Netherlands have draft legislation released. And at this stage, China has not made any announcement, but I expect China will implement Pillar 2 as well. So when does the rules apply, and who do they affect or impact? So the rules will apply, generally speaking, from 1 January 2024. So income years commencing 1 January 2024. So Australian headquartered groups are likely to have a June balancing date. Therefore, the start date would be 1 July 2024. Now, there's a separate rule, which is called the untaxed payment rule. And I'll go through what that is. That rule will kick in 1 year after. So 1 January 2025. Now, who is within scope of the rules? So you have to be a multinational enterprise, MME group. So therefore, your group must operate at least in 2 jurisdictions. And that group must have an accounting. So this is accounting turnover, accounting global consolidated turnover of 750 million or more. And that translates to about AUD 1.2 billion. So you must exceed that threshold in 2 out of the 4 years before the test year. So you note that you're looking at 2 out of the 4 years before the test year. So at the start of the test year, or the start of the year, at the start of 1 January 2024, for example, you would know if you are within scope. In working out whether you exceeded that threshold, you need to include the turnover of excluded entities, and we'll explain what that term means. Also, a trap area that you need to be aware of is you do need to take into account mergers and acquisition transactions which occur during the test period. So let's look at a simple example which involves a merger. So here assume that group 1 and 2 merge in the test year. So let's say the test year is the year ended 31 December 2024. So test year number -1 would be 31 December 2023, 31 December 2022, and so on. So you look at the 4 years before the test year. Group 1 in 31 December 2023 has a consolidated turnover of 500 million. Group 2 has a consolidated turnover of 350 million euros. The total is 850 million. Going back 1 year, the total turnover of the 2 groups is 800 million. So just looking at those 2 years, the combined turnover has exceeded euro 750 million. Therefore, the requirement is satisfied. Pillar 2 will apply to the merged group. So to give you an idea as to how Pillar 2 operates, let's firstly look at a simple example. So in this case, you have an ultimate parent entity. So the acronym is UPE. It is located in country A, and it has a subsidiary in country B. And generally, we call those subsidiaries or permanent establishment constituent entity. Okay, when you see that term. So subsidiary B is located in country B. Country B is a low tax jurisdiction. Subsidiary B has globe income of $1,000, and we'll look at that definition. At this stage, I'll note that the term income does not mean gross income. It is referring to profit, right? Income minus expenses. So globe income is $1,000. Adjusted covered tax, and we'll look at that term as well, is $50. The effective tax rate is basically the adjusted covered tax rate divided by the globe income. So that's 5%. So this number is less than 15%. Therefore, we have a top-up tax percentage. So country A looks at all its subsidiaries and calculate the top-up tax percentage, which is the minimum rate minus the effective tax rate in that jurisdiction. And it multiplied that top-up tax percentage by something called excess profits. So at this stage, we'll go through what that means. At this stage, assume that excess profit is globe income. So 10% times the globe income of 1,000 is a top-up tax payable of $100 payable by the ultimate parent entity in its jurisdiction. Okay, now when we discuss the charging mechanism, we will see that it's not always the ultimate parent entity that pays the top-up tax. So one example would be, for example, if you got Australia in the middle, that is an intermediate holding company. Let's say country A has not implemented Pillar 2, then it is Australia that will collect the top-up tax. Also, we have countries like Australia, which will introduce what is called a qualified domestic minimum tax rule. So what the domestic minimum tax rule does is to collect the top-up tax that is attributable to all the entities in Australia. So only in Australia. So it's meant to protect the Australian tax base. So let's go further into how the charging mechanism operates. So firstly, we spoke about the qualified domestic minimum tax. And what that does is to allow the relevant country to collect top-up tax in relation to taxpayers within its jurisdiction. And I also know that I've seen announcement by tax havens that they are introducing a 15% corporate tax rate for large groups which are subjected to Pillar 2. So that's a different way to set a minimum tax. So you have the qualified domestic minimum tax for each country to collect the top-up tax for entities within its jurisdiction. Then you have the income inclusion rule. So the income inclusion rule is that example we looked at earlier, where the ultimate parent entity collects the top-up tax for its subsidiary based on its ownership interest in that subsidiary. Then you have the untaxed payment rule. Now, you recall earlier I said that the untaxed payment rule will come in 1 year later. That's from 1 January 2025. So what the untaxed payment rule does is to collect any top-up tax that has not been collected under the income inclusion rule. And I'll show you an example as to how that could happen. So the each jurisdiction will specify in their domestic law how the untaxed payment rule and how the top-up tax will be collected under the untaxed payment rule. This could be by way of denial of deductions or additional levy to be levied by the Australian Taxation Office. So in what circumstances would the untaxed payment rule, which is like a stopgap measure, how could it be triggered? Let's look at a simple example. So here, in this case, we got the ultimate parent entity in jurisdiction A, and jurisdiction A has not implemented the GloBE rules. It has two subsidiaries in jurisdiction B and jurisdiction D. So BCO and DCO are in jurisdictions which have implemented Pillar 2. Then we have CCO in a low tax jurisdiction. So there's top-up tax that is payable in relation to CCO. So when we look at ACO, the country has not implemented Pillar 2. So the top-up tax is not collected under the income inclusion rule. Therefore, what happens is that the top-up tax is allocated to BCO and DCO based on a specific formula. Now, the important point here is, and you would have noticed this as well, BCO and DCO has no interest in CCO. And secondly, BCO and DCO might not even know the existence of CCO. Nevertheless, the top-up tax in relation to SECO has been allocated to them. Okay, so when the untaxed payment rule kicks in, you probably could work out whether it would be triggered by looking at the group structure. But you should, before you lodge your tax return, make inquiries of your head of tax to ensure that there is no top-up tax allocated to your company in Australia under the untaxed payment rule. So the question which you might have is, if I am headquartered in Australia, what would be my obligations? So if you are an Australian headquartered group, it makes sense that you'll be responsible for performing the globe calculations, and you should take charge of the processes, systems, software, and implementation of Pillar 2. Why? Is because you would have most of the information in relation to all your jurisdiction. And the first source of information would be your financial accounting consolidation work papers. However, I note that because of the calculation, because that globe income requires adjustments to accounting profit, you will require specific, I would say you might require specific tax information from your foreign subsidiaries. Now, you can approach this two ways. You could get that information from your subsidiary and complete your software or tables, or you can send a template to your overseas subsidiaries to complete, and then you bring the information into your calculation. So once you have performed the calculations, you need to lodge the GLOBE return. So GLOBE is an acronym for Global Base Erosion. So somebody needs to lodge this return. If your Australian headquartered, is likely to be you. So you lodge it with the ATO, but you do not need to lodge the same return in every single jurisdiction in which you operate, because the overseas tax authorities, provided that there is an information exchange mechanism, would get that information from Australia. Your other subsidiaries, though, however, would have the same obligations as the Australian subsidiary, which we'll talk about in the next slide. If you're an ultimate parent, you're headquartered in Australia, your first lodgement is likely to be 31 December 2026, so just over two years. But there are certain things that you can do now to prepare, and I would suggest that as a minimum to perform the safe harbor calculations. And we'll talk about what that is. The safe harbor calculations would inform you on the level of work or calculations you require for Australia and your overseas jurisdictions. So how about subsidiaries of foreign headquartered groups? Given that the parent company is performing the calculations, do you have any obligations in Australia? So it's likely that your parent will perform the calculations, and they may require specific information from you, and they can do it two ways. They can ask the information from you, or they might require you to complete a template. Despite the calculations being lodged in the foreign jurisdiction, you are most likely required to lodge two other forms in Australia. So that could be the domestic minimum tax return and information as to where the ATO can access the GLOBE return data. So if you're a December year-end, your first lodgement would be expected to be 30 June 2026. Also, when Australia implements the untaxed payment rule, then you should make a further inquiries as to whether or not there is any top-up tax allocated to you under the untaxed payment rule. Now, I will also suggest that if you are a subsidiary of a foreign headquartered group, as a minimum, I would suggest that you also perform the safe harbor calculations, because it's not difficult to do. And that will inform you as to the level of information which your parent company may require from you, right? So if the safe harbor rules apply, it is likely that you will be left alone, basically. So what is the safe harbor rules? So there are two types of safe harbor rules. One is the transitional safe harbor. So that will apply until the end of the income year, 30 June 2028. So you basically have 2 years of a transitional period where you can do simple calculation. There's also a permanent safe harbor, which I will not go into at the moment because it's too early and we're still waiting for more guidance or rules in relation to those calculations. So this is a transitional safe harbor. If the transitional safe harbor applies to your jurisdiction, the top-up tax is deemed to be nil. And further, what that means and what that could mean is that you might not need to go through the detailed calculation of globe income and adjusted covered taxes. But this is to be confirmed when Australia release our legislation. But looking at the Pillar 2 SML schema and instructions issued by the OECD, it seems to me that if you satisfy the safe harbor rules, you don't need to go through the detailed calculation of globe income, which makes sense to me. Otherwise, it defeats the purpose of the safe harbor. So for the safe harbor rule to apply, you need to satisfy one of the 3 tests which you see on the screen. And I've highlighted or put in the box the one that I think will most likely apply to Australian groups. But let's go through all 3. You need this is an all test, and you only need to satisfy one out of the 3. So the first one is the de minimis concession, and it applies if, and this is the beauty of it, is you can go to your CBC report and grab the information from there. So you look at what the CBCR revenue is in the report for the jurisdiction. If it's less than 10 million and the profit or loss before income tax is less than euro 1 million, so euro 10 million and euro 1 million, then you satisfy the de minimis test. So this is only if you're in Australia, you only look at the Australian revenue and profit or loss. The second one is the simplified effective tax rate concession. So here, what you do is basically you take the income tax expense for that jurisdiction or for the entities in that jurisdiction, and you divide that by the profit or loss before income tax in your CBCR, country by country report for that jurisdiction. Okay, if it's greater or equal to the transition rate, so the first year the transition rate is 15%, and then it goes up to 17% by 2028. If it's greater or equal to that rate, then you satisfy this safe harbor concession. The final one is a substance-based income exclusion concession. So substance-based income exclusion. So in this case, if your profit or loss before income tax is equal or less than the substance-based carve-out as calculated under the GloBE rules, then you satisfy this concession. So we'll go through what it means, a substance-based carve-out, but basically to help you remember, how do you show substance in the jurisdiction? One is you have employees, right? And secondly, you have substantial assets in that jurisdiction. So the rule basically allow you to take a percentage of your payroll costs and the average value of your tangible assets and calculate a substance-based carve-out amount. So if your profit is equal to or less than that amount, then you satisfy this requirement. I've provided a more detailed explanation of what the simplified ETR calculation is. But basically, it's your income tax expense per your accounts divided by your profit before income tax in your CBCR report for that jurisdiction. And if you have any questions, feel free to put them, raise them using the Q&A button, and I'll happy to address them. Okay, so there is annual de minimis jurisdiction exclusion election available, and this applies obviously permanently. I would say that if you cannot satisfy the safe harbor provision, then you won't satisfy this de minimis exclusion. And in order to perform the de minimis exclusion, you will need to perform the GloBE calculations. So there is no simplification in that sense. But if the de minimis exclusion rule apply, then your top-up tax is deemed to be nil, and you don't need to disclose your GloBE, GloBE income, etc., in the GloBE return. Okay. So Genji has you asked how the effective tax rate is calculated. That's a good question. We'll be going through a simple example, and that will give you an idea as to how that is calculated. So firstly, do your safe harbor calculations, and our Pillar 2 team members will be happy to help, and Anthony and Kate is here with me to assist with questions if required. So if let's say you do your safe harbor calculations and you have jurisdictions where you don't satisfy any of those, that means it's likely that you need to perform the detailed GloBE calculations. So generally speaking, in order to perform those calculations, these are the general steps to follow. So firstly, for each year, you need to work out whether you are within scope. So this is the turnover, the global group accounting turnover exceeding 750 million euros in the 4 years prior. Okay, so if you are within scope, you then determine all your constituent entities in the group. So I'll say two things here. They are likely to be the same entities as your accounting consolidated group. And number two, they are likely to be the same entities which you have listed in your CBCR calculations. Okay, they are likely to be the same. So once you have identified your constituent entities, and generally speaking, you need to perform the calculation on a bottom-up basis. So let's say you have 3 entities in Australia, you perform 3 separate calculations. So you calculate the GloBE income and for each entity, and you calculate the adjusted covered taxes for each entity. Then what you do is you sum up the amounts for each jurisdiction and calculate the jurisdictional effective tax rate. And Jan, the effective tax rate is basically your jurisdictional adjusted covered taxes divided by the GloBE income. And we'll go through a simple example as well. Okay, so if this rate is less than 15%, then you need to apply the charging mechanism to allocate any top-up tax payable. So this is the broad steps to perform your Pillar 2 calculations. At this stage, I note that we will be releasing our Pillar 2 software to assist with the calculation and to assist with the lodgement of the Pillar 2 forms. However, we'll only be officially releasing the software once the legislation has been released by the Australian government and the relevant GloBE returns, domestic returns, and other informational return. The schema has been released by the Australian Taxation Office. So at this stage, if you require assistance from our Pillar 2 team members to help you with the safe harbor calculations, and also to perform the Pillar 2 calculations for jurisdictions where the safe harbors do not apply, this is likely to be the tool we will use to assist with those calculations. Pricing of the software has not yet been determined at this stage. So remember I said earlier that in working out whether you exceed that threshold, you need to also include the turnover of excluded entities. And why I said that is because for excluded entities, you do not need to calculate the ETR, effective tax rate, for them. Okay. However, you still need to include their turnover in working out whether you exceed the 750 euro million threshold. But I suspect that it's highly unlikely that you will have an excluded entity within your group. So what are excluded entities? They include government entities, international organizations such as the United Nations or the International Monetary Fund, non-profit organizations such as World Vision, pension funds, and this term is probably of interest to you, investment fund that is an ultimate parent entity, a real estate investment vehicle, okay, that is an UPE. So even with stating this, you know that there is no exclusion for financial services entity, unlike the thin capitalization rules. So we'll go to those terms because it might be of interest to some of you. You also can include subsidiaries of excluded entities, but you need to satisfy two tests. One is an ownership test, so excluded entities above needs to own at least 95% of the subsidiary in terms of value of ownership interest. There is also an activity test. That is the subsidiary exclusively or almost exclusively hold assets or invest funds for the benefit of the excluded entity, or what they do is really activities ancillary to those carried out by the excluded entity. Now, if the subsidiary whose income is substantially comprised by excluded dividends or gains, and we'll look at those terms when we hold the workshops, the ownership interest can reduce to 85%. Okay, so if you got excluded entities, you do not need to perform these CBC calculations for them. So what are investment funds and what are real estate investment vehicle? Is that sufficient that I have a subsidiary that is holding shares or investments on behalf of the group? An investment entity, and this is the full definition, but broadly speaking, it will be consistent with your understanding of a managed fund, right? So it will have a separate manager that manage the assets. The fund is widely held, where funds are pooled to invest in investments. The manager will perform the research, analysis, etc., and the fund will be regulated by the MIS regime, for example, or subject to the rules imposed under the corporations law. Similarly, for the real estate investment vehicle, it must be widely held. It must predominantly hold property, land, buildings, and either the trust is the trustee or the trust is taxed, or its beneficiaries are taxed within a year of the year end. So it needs to meet those definitions. All right. So once you worked out that you are within scope and identify your excluded entities, unlikely to be any, I would imagine, for a normal group, you then need to identify your constituent entities. So firstly, you need to identify the MME group, which is basically which I would say the group in your financial accounting group. And again, you must have operations in more than one. So at least two jurisdictions. All right, purely domestic groups are not included or not within scope. You then identify the ultimate parent entity, and generally speaking, it should be the same as your parent entity for your financial accounting consolidation purposes. From that, you identify your constituent entities, which will include companies, controlled trusts, controlled partnerships, and like country by country reporting, permanent establishments are deemed to be separate constituent entities. So you need to identify those, and it's likely that your constituent entities are already listed in your CBCR work papers. Okay, so we'll now go through the calculations, very simple calculations. So once you have identified your constituent entities, you group them by jurisdictions, and then you perform the calculation on a bottom-up basis. So you do a calculation for each entity within the group. You have a drink of water. So your starting point is to calculate the group income of each constituent entity. And remember, I said as a parent, you're likely to have the information to do the calculation because the starting point is your financial consolidation work papers. So you start with a net profit after tax based on your financial consolidation work papers. You ignore elimination entries. And then from there, you make the adjustments required under the Pillar 2 rules. And we'll go through those adjustments in our upcoming workshops, which we plan to hold. It's noted that once you have calculated the group income, you might need to do some reallocation of that income for permanent establishments, tax transparent entities, and hybrid entities. So let's look at a simple example. Let's say you have an ultimate parent entity with subsidiaries in Singapore, Cayman Islands, New Zealand, and 2 subsidiaries in Ireland. The net profit before tax is $100, and this is the currency in your financial consolidation work papers. You start with the numbers in the financial consolidation work papers: $100 in Singapore, 200 in Cayman Islands, 300 in New Zealand, etc. And you ignore elimination entries. The income tax expense is $17 for Singapore Co., $2 for Cayman Islands, etc. The net profit after tax is 100 minus 17, 83 for Singapore Co., 500 minus 35, 465 for Ireland Co. So straightforward calculations. So with that, you perform your globe calculations. So the net profit after tax is 83 and 198 for the Cayman Islands, etc. One of the adjustment required under the Pillar 2 rules is income tax expense. So I added back $17, and that gives me a globe income of $100 for Singapore, $200 for Cayman Islands. Now, I note here that this is a very oversimplified calculation example, just to give you an idea as to how it is performed. It is extremely likely, and 99% the case, that your globe income will not equal your net profit before tax. It will not be the same. It will be a different amount. So at this stage, let's assume that the income tax expense is the only adjustment required. So we got a globe income of 100 for Singapore and 200 for Cayman Island and so on. Next, for each constituent entity, we need to calculate the adjusted covered taxes. So adjusted covered taxes relates to taxes on profit. So it does not include GST, land tax, stamp duty, PAYG withholding, etc. So for each constituent entity, you start with the current tax expense in the financial consolidation work papers, and then you make all the adjustments required under Article 4, which is the Pillar 2 rules. Then finally, you may also do some reallocation, and we'll go through this in our workshop, for taxes relating to permanent establishments, CFCs, controlled foreign companies, tax transparent entities like trusts, and hybrid entities, and those subjects to dividends and those that are dividends and other distributions. So let's say that the adjusted covered, the income tax expense in the accounts comprise only of current tax expense, and that's the number $17 in Singapore, $2 in Cayman Islands, etc. And let's assume that that is the only adjustment required, which is 100%. The case that you would not, the adjusted covered taxes would not equal your current taxes because you have to make quite a number of adjustments under the Pillar 2 rules. But at this stage, let's assume that adjusted covered taxes is the current tax. So once you have performed the globe income calculation and adjusted covered taxes, you'll combine them together or consolidate them on a jurisdictional basis. So in this case, you'll add up the two amounts for the two Irish subsidiaries. So you'll calculate the effective tax rate on a jurisdictional or country by country basis. Is calculated, is rounded to 4 decimal points. And how you perform that calculation is you sum up the globe income by jurisdiction. You don't have to worry about calculating the effective tax rate if you are in a net globe loss position for the jurisdiction. You then sum up the adjusted covered taxes, if relevant, by jurisdiction. And you calculate the effective tax rate by dividing the adjusted covered taxes by the globe income. If it's less than 15%, then you have a top-up tax percentage in that jurisdiction. That top-up tax percentage is then applied to what is excess profits. So excess profits, remember we spoke about substance-based inclusion or exclusion rule. Here in this case, your excess profits is a recognition of the substance you have in a particular jurisdiction. So you start with the globe income, and then you reduce it by a certain percentage of your payroll costs and average value of your tangible assets. And payroll costs and included assets are all defined, and right of use assets are also included as well within the tangible assets. So that percentage starts from 7.8% in 2024 and eventually reduced to 5% by within a decade or in a decade. Okay, so at this stage, let's assume globe income equals excess profit. So there is no adjustment for payroll costs or that value of tangible assets. So here we got the globe income for Singapore is $100, and you notice that we have summed up the two subsidiaries for Ireland, so it's 600. The adjusted covered taxes is $17 in Singapore. So to calculate our effective tax rate, we take the adjusted covered taxes divided by 100, which gives us 17% in Singapore. We do the same thing for Cayman Islands. 2 divided by 200 is 1% in the Cayman Islands, 28% in New Zealand, and 6.8333%, rounded to 4 decimal points, in Ireland. So we then work out, well, do we have a top-up tax percentage, which is basically the minimum tax, 15%, minus the effective tax rate if it's lower than 15%. So here we have Singapore 17. Well, there's no top-up tax percentage because it's greater than 15%. We have a problem in the Cayman Islands. So the minimum tax, 15% minus 1%, gives us a top-up tax of percentage of 14%. No issues in New Zealand, which is good. Ireland, we have a problem. There's a top-up tax of 8.1667. So 15 minus 6.833. We then take that number, top-up tax percentage, and we multiply that by excess profits. So let's assume excess profits equals globe income. So 14% multiplied by 200 gives us 28 top-up tax payable for Cayman Islands and $49 payable in relation to Ireland. So if we have a top-up tax payable, then we apply the charging mechanism to pay the top-up tax. So this could be by way of the income inclusion rule, domestic minimum tax rule, or the untaxed payment rule. Okay, so I explained earlier what the excess profit is recognizing the substance within a jurisdiction. So globe income, which is a positive thing, globe income is reduced by a percentage of payroll costs and a percentage of the average value of the tangible assets. So as I said, it starts with 7.8% for 2024. So that's the same percentage, eventually reducing to 5%, and it'll stay there permanently. Okay. So what about accounting for income taxes? So what do you need to put in your financial statements? So AASB 2023-2 provides temporary relief from accounting for deferred taxes arising from Pillar 2, which is good. However, you need to make targeted disclosure requirements relating to known or reasonably estimatable Pillar 2 exposure. And I'll say this, by performing your safe harbor calculations might reveal that you might not have an issue or top-up tax or effective tax rate problem in Australia, and that might inform you as to the disclosures to make in your financial statements. However, this is something new and something that you should discuss with your auditors probably sooner rather than later. So that applies from annual period starting on or after 1 January 2023. And as I noted earlier, the Pillar 2 rules is intended to apply from income years commencing on or after 1 January 2024. So please look out for our planned workshops, and this will be after the government has introduced the Pillar 2 exposure draft legislation, and depending on, and also potentially once the ATO has released the SML schema for Australia, which is likely to be similar to the OECD schema. In those workshops, I assisted with my Pillar 2 team, including Anthony Chung and Kate Whitman. We'll go through in detail the calculation of the globe income, and we'll use our CTS Pillar 2 software to perform those calculations examples. We'll look at the calculation of adjusted covered taxes. You'll be familiar with those two terms now. The calculation of top-up tax percentage and the top-up tax payable, and then look at how the charging mechanisms operate. And it is a bit more complicated than what I've covered in today's presentation or webinar. Okay, so I might now open up for questions. And yep, so feel free to put through your questions if you if you have any, in terms of, I guess I must start with a question to myself. I've already mentioned it. When do I expect the legislation to be released? I expect that to be early next year, perhaps in the first quarter. And how does the rule in New Zealand look like? New Zealand basically refers to the Pillar 2 rules, but I think Australia might take a different approach, but we'll have to wait and see. Okay. So this is a very good question. What happens if a company has tax losses carried forward? So this will be covering in our workshop. You, as part of covering in calculating the adjusted covered taxes, broadly speaking, you can make an election to recognize what we call a deferred tax asset at the minimum rate, to recognize the fact that you have tax losses. So in effect, prior tax losses are taken into account. So obviously, they will reduce your effective tax rate. I might also say that your effective tax rate under the safe harbor rules could be lower than if you have performed the calculations. And the reason is you do not subtract dividends and distributions from accounting profits, so that will affect your safe harbor calculations. And also, I note that there are adjustments to the safe harbor calculations, so it's not as simple as I put on the screen. There are adjustments for unrealized losses, etc. So you just need to take into account specific adjustments. So I've got a question from Eric, and the question is, if the ultimate company applies GloBE, which is Pillar 2 rules, and your immediate parent doesn't, can Australian company rely on the parent to work out the calc, and we do not worry about the untaxed payment rule? So if your ultimate parent jurisdiction has implemented Pillar 2, it will be the one that collects the top-up tax and pay to the tax authority in its jurisdiction, irrespective of whether the intermediate parent jurisdiction has implemented Pillar 2. The issue is if it's in reverse. So let's pick China, because China has not made any announcement for the Pillar 2 rules, right? So let's say China has delays in implementing Pillar 2. Australia is an intermediate holding company, and Australia has subsidiaries offshore as well. Australia has implemented Pillar 2. So because China has not implemented Pillar 2, it is Australia that will collect tax under the income inclusion rule. Okay, so but if you're comfortable, you look at your group structure and you know that your ultimate parent entity is in the jurisdiction that has implemented Pillar 2, then that gives you comfort that your parent company would be the one that collects the top-up tax. But two exceptions: Australia might implement domestic minimum tax, so you need to work out whether there's any top-up tax in Australia. Unlikely, but you need to check that. And number two is the untaxed payment rule. Okay, so the example that I went through earlier, you could be hit with an untaxed top-up tax under untaxed payment rule on an entity which you do not have any interest in, or you might not know is in existence. So you need to make that check, but that is 1 year later, from 1 January 2025. So I might click done on that. So Genji asks, would there be a Pillar 2 return that needs to be lodged? It's likely to be. So what what do we need to lodge in Australia? Okay, so I'll differentiate between an Australian headquartered group and a subsidiary of a foreign headquartered group. The Australian headquartered group is likely to be required to lodge the GLOBE returns, which contains all the GLOBE detailed calculations, uh, potentially domestic minimum tax return as well, but perhaps there's some administrative concession. And I think that'll be it. And the third one would be for a subsidiary, the ATO would obtain the GLOBE return through the information exchange mechanism, but the subsidiary in Australia might still need to lodge the domestic minimum tax return, even though you might not have any domestic minimum tax payable, but we'll see what the rules are and potentially information to let the ATO know who is lodging the GLOBE return and in which country. So that means subsidiaries, you still need to determine, work out, you need to obtain the software to lodge the SML data with the ATO. And we will be releasing our CTS Pillar 2 to assist with this. I've got another question from Jimmy. Jimmy is asking, I am a small foreign-owned company in Australia as part of this SGE. What do we need to do now? So if you're a foreign subsidiary, Jimmy, I would recommend that you do the safe harbor calculations. So if you satisfy one of the concessions in the safe harbor rules, it's likely that you do not need to perform the detailed GLOBE calculations, and you can expect that your parent will probably not require anything or a lot from you. However, you still need to talk to software vendors to ensure that you have the ability to lodge the relevant returns with the ATO. And again, we will be releasing software to assist with that. So I'll okay. All right. So I think that we got a minute left. I just want to take this opportunity to, I think it's wonderful to have you all join us today for the Pillar 2 session. Thank you very much. We will notify you once we have planned the workshops and look forward to seeing you there. If you have any questions which you might not thought of now but comes up later, feel free to shoot us the email. We're happy to help or answer those questions where we can. All right, so have a wonderful day. Have a splendid day, and I'll see you around if we have not met. Thank you.